Let's take a look at standard costs and variance analysis. And we are dividing this into two parts, direct materials and direct labor variances is in this first part. There will be a second video that looks at overhead variances. Now, a static budget, which we'll be doing in our next module, we'll be looking at budgets and how to prepare budgets. The static or master budget is prepared for only one expected level of sales volume. So for a manufacturing company, we're going to show budgeted amounts in that budget for direct materials. Each separate direct material will be listed out and budgeted, and direct labor and overhead. These budgeted amounts are based on the expected amounts we have to pay, which we're going to research and come up with, and we call those standard costs. The flexible budget shows the expected revenues and costs for each possible level of sales volume above and below the static budget. So we make this master static budget for just one volume that we really think we're going to do. So, for example, if the static budget is based on 50,000 units to be sold, we think that that's the best number we can come up with of how many units we think we're going to sell next year. Then we make a flexible budget, and the flexible budget is based on the static budget, but may show budgeted amounts. Well, what if we only make 46,000 or 48,000? Or what if we sell more units like 52,000 or 54,000? So each of those flexible budgets will have the direct materials, direct labor, etc., all based on that number of units. Then, when that actual month or quarter or year is done with, and we see exactly how many units have we sold. So, if it turns out that we actually sold 52,000 units, then we want to compare the budget for 52,000 units to the actual costs that we had for 52,000 units. A standard cost, again, is what we're going to use to make that budget. And this is the price, cost, or quantity that is expected under normal conditions. And they're set for materials, labor, and overhead. So, for example, Premium Pooch Palaces expects that it takes 32 shingles for a particular doghouse, that each shingle will cost 50 cents. Those become the standard quantity, 32 shingles, and cost 50 cents for shingles, which is a direct material. Setting standards requires coordination among managers and accountants of different divisions. So coming up with the 32 shingles and coming up with the 50 cents is not just picked out of the air. There has to be a lot of research into this and exactly what those numbers are, because even a penny can make a difference. Even one shingle or one penny can make a serious difference when you're talking about a longer time period for comparing those expected standards to the actual that we have to put on there. The standard shouldn't be changed, however, unless there's an actual change in the quantity or cost, not just because the actual costs were higher than expected. So in other words, if we expect the shingles to be 50 cents. We've done a bunch of research, and that's what they should be next year. When we're making our budget this fall or this summer for next year, we truly have researched and expect the shingles to be 50 cents. But maybe there's a huge hurricane or something, bunch of stuff happens between now and next year, and it causes the shingles to cost more next year than we envisioned. And so they end up costing 52 cents because of these various other things that happen. In that case, we can go ahead and change the standard to the 52 cents, but only if it's because, this is a permanent change for this year. And we can point to a reason for why it's 52 cents. We don't change it just because there was a particular month or quarter when we happen to have to pay 52 cents. Okay? We do it only if it's a permanent change. Variances are the differences between the actual revenue or cost that we paid or received and the budgeted revenue or cost that we have on the budget, on that flexible budget. Okay, the variances are favorable if it increases operating income. So if I have less of a cost actually than what I thought I would have, that means my operating income is going to be increased. It's going to be more because my expenses are less. And so that variance would be considered favorable. It's unfavorable if it decreases the operating income. So if my actual cost that I spent for shingles was more than what I thought it would be, then that means my operating income is going to be less, and that would be an unfavorable variance. The variances are then analyzed. Once we have the variance and we know whether it's favorable or unfavorable, then we got to analyze it. Determine why does this difference exist? Who is responsible for this variance? And then we have to further investigate. Okay, so for example, if the cost of the shingles turns out to actually be 58 cents rather than 50 cents, the variance will be investigated with the purchasing manager to see why the cost increased. If a different vendor could be used, if this is a permanent change for some reason, or if they were just trying out maybe a higher quality shingle with the idea that that these shingles would be a better quality. If we have gotten complaints from customers about the quality of the shingles or something like that. So there could be many reasons why we had to pay the 58 cents, and we need to investigate that with the purchasing manager. Only if the actual cost is expected to remain in the future will the standard be changed. So if we now expect that the shingles are going to cost 58 cents a piece for the rest of the year, then we will change the standard and not keep using the 50 cents. We have a flexible budget performance report that we do. This lists the budget amounts for revenues and costs, compares them to the actual amount along with the variance. So we have three different things here. We're going to have the original static budget for the 50,000 units. Then we will have the flexible budget for the 52,000 units that we actually sold, and we'll have the actual cost for the 52,000 units that we actually sold. So we're going to have three things. And we're going to compare the static to the flexible budget, and we call that difference a sales volume variance, because that variance exists because we sold more, in this case, units than what we thought we would sell. And that's going to cause our costs to also be more, especially variable costs. Then we're also going to compare the flexible budget variance, which is the flexible budget for the 52,000 units, and we're going to compare that to the actual cost that we had for the 52,000 units. And that's called the flexible budget variance. We're only going to be looking at, during this section, we're only going to be looking at the flexible budget variances. And on your exam, etc., and assignments, we're going to be considering the flexible budget variances. These are the most important. These are the ones we truly want to investigate, and that are seriously important inside the actual real life company. So you will have to be told, as far as an assignment or exam, how many units were sold. And we're going to use that number then to determine the total standard cost for direct materials, direct labor, and variable overhead. For fixed overhead, budgeted amounts, we use the original estimated amounts. They're not dependent on how many units are sold. So we estimated, for instance, how much we're going to have to spend on insurance for the factory building. It doesn't matter how many units we sell or don't sell. That's the estimated budgeted amount for insurance. And we're going to use that for fixed overhead. Okay, but for these variable costs like direct materials, direct labor, and variable overhead, we're going to have to determine what the total standard or what the total budgeted cost is, so we can then compare that to the actual. Okay, so for direct material variances, the flexible budget variance for direct materials is further analyzed to determine whether changes in costs, which is called the cost variance, or in quantities used, which is called the efficiency variance, or both, are responsible for the difference that we're seeing in the total flexible budget variance for direct materials. Now, we have a bunch of different names. The book you use, maybe other Google resources, whatever, may use different names for the cost variance. I use the word cost variance for your assignments and for your exam problems. But they might be called in your book or other places a price variance, a rate variance, or a spending variance. All of these mean the same thing, so don't let yourself get confused. The efficiency variances may also be called a usage variance. All right, so when we're looking at direct materials variances, again, we're going to divide those into cost variances and efficiency variances. So the cost variance looks at comparing the actual cost per unit of the material that we use to the standard or expected amount we should have paid per unit for that material. And typically, we're going to do this for each material. So if we have 10 different materials that are direct materials that go into that product, then we're going to have 10 different cost variances. We'll look at each material. Now, for the sake of exams, etc., we only look at one material. So, but you would follow the same exact process for looking at any other materials. So the direct materials cost variance formula is the actual cost, and this is the actual cost per unit, and we subtract out the standard cost per unit, and then that difference is multiplied times the actual quantity of that material that we used. And then we have to determine whether or not that variance is favorable or unfavorable. So to put the formula shorter, we have AC minus SC, and we're going to multiply that times the AQ, which is the actual quantity. For the efficiency variance, we're looking at comparing the actual quantity of material used to the standard or expected amounts we should have used for that number of units. So the direct materials efficiency variance formula is the actual quantity we used minus the standard quantity we thought we should use, and we're going to multiply that times the standard cost per unit. Let's look at an example for this. And we're going to use Cheerful Colors. This is a company that manufactures crayons. Okay, so for direct materials, they determined ahead of time, last year, that a standard usage of paraffin wax to make the crayons is 1 pound per box of crayons at $1.75 per pound. So if the actual number of units sold is 52,000 boxes of crayons, then our flexible budget would show 52,000 boxes of crayons times 1 pound of wax for each box, and multiplying that times $1.75 that we have to pay for each pound. So we get $91,000 for the cost of the paraffin wax would be on our flexible budget for the 52,000 boxes of crayons. If, however, the actual cost for paraffin for the 52,000 boxes is $104,000, that's what we actually paid, and we actually got 65,000 pounds of paraffin wax that we used, okay, then how much did we pay per pound? Well, we paid $104,000. We divided that by the 65,000 pounds, and we get $1.60 per pound. That's how much we paid per unit, per pound. And we used 65,000 pounds. So that's our actual quantity. So first we take a look at the total flexible budget variance. So we take the total standard for 52,000 boxes of crayons, which was $91,000. We subtract out the $104,000 that we actually spent for those 52,000 boxes of crayons. And that difference between $91,000 and $104,000 is $13,000. Okay, now, is this favorable or unfavorable? Since we spent more on the paraffin than we thought we would have, that's going to cause our operating income to go down. And so we're going to call this unfavorable. We have a $13,000 unfavorable total variance. Now we're going to take that and divide it out into how much of that is related to the cost variance and how much is related to the efficiency variance. So this slide shows you the cost variance. And just to reiterate, our standard cost was $1.75 per pound for paraffin. The actual cost was $1.60. We got that by taking the actual cost of $104,000 divided by the 65,000 pounds, and we got $1.60 per pound. That's what we actually paid per pound. The actual quantity we used was 65,000 pounds. So we now have everything we need to be able to plug into our formula. And remember, our formula for a cost variance is the actual cost, and that's per unit, minus the standard cost, and again, that's per unit. And we're taking that difference and multiplying it by the actual quantity. So here we have our actual cost per unit is $1.60 per pound of paraffin. And we're going to subtract out the standard cost per unit, which is $1.75 per pound of paraffin. So that difference, which is 15 cents per pound, multiplied by the 65,000 pounds we actually used, is $9,750. Now, we go back into our formula. At the beginning of our formula is the actual cost. Compare that to the standard cost. Our actual cost of $1.60 is less than the standard cost. So we paid less per pound than we thought we would. So that's going to cause our operating income to go up. And so this is a favorable variance, 97.50, favorable direct materials cost variance. Now here's the efficiency variance. So just to re-summarize, the standard quantity of paraffin that we need is 1 pound per batch or for each box of crayons, okay? We had 52,000 batches or boxes were sold, so 52,000 pounds of paraffin were expected, 52,000 times 1 pound per box, okay? The actual quantity that was used was 65,000 pounds. We thought we would use 52,000 pounds, but we actually used 65,000 pounds, 13,000 pounds more than expected. The standard cost, and realize that 13,000 has nothing to do with the 13,000 total variance in dollars. It just happens to be the same number. The standard cost per pound is $1.75. So we now have everything we need to plug into our formula. Remember, our formula is AQ, actual quantity, minus SQ, standard quantity, and that difference times the standard cost per unit. So let's see how that plays out. Our actual quantity is 65,000 pounds. We subtract out what we thought we would use, our standard quantity of 52,000 pounds. That difference, which is 13,000 pounds, is then multiplied times the standard cost per unit, which is $1.75 per pound. And we get $22,750. We go back into our formula and we see that the actual quantity is more than the expected quantity. So we're using more wax than we thought. That means our operating income is going to be decreased. And so this will be an unfavorable variance. Whenever the actual is more than the standard, we will have unfavorable. If the actual is less than the standard, we will have favorable. Okay, so now we've analyzed the direct material total variance of 13,000 unfavorable into two parts. The 97.50 favorable cost variance and the 22,750 unfavorable efficiency variance. Now we can combine those two just to make sure that we're right. If they don't combine to 13,000 unfavorable, then we did something wrong. Okay? Now, if we have two favorables, we're going to add those. If we have two unfavorables, we will add them. But if we have one favorable and one unfavorable, then we will subtract. Here we have a 97.50 favorable and a 22,750 unfavorable. So we're going to subtract. So the 22,750 unfavorable minus the 97.50 favorable is 13,000 unfavorable. So that matches our total variance. So we did good. We have explained the variance by showing that we have more operating income because we paid less per pound for paraffin, but we used 65,000 pounds rather than 52,000 pounds. We wiped out the gains that we made from the cost savings, plus we also decreased operating income even further. This whole thing might have happened if the quality of the cheaper paraffin was low and required us to use more of it. So the purchasing manager went and got the paraffin for $1.60 a pound. And that was like, oh, wow, this is great. However, if that paraffin was really bad quality, and so we had a lot of waste, we had to use more, it didn't mix with the colors well, whatever, all kinds of things might have happened because of the fact that we got lower quality. Okay, so these variances are going to be further investigated. And at the end of the next video, we will take a further look at what kinds of questions, who are we going to talk to about these, and what kind of questions are we going to ask when we're investigating. Now let's move on to direct labor for cheerful colors. They decided that the standard usage is 1/4 of an hour of direct labor, and they pay on average $12 an hour for each box of crayons. Okay, so $12 an hour for each hour of direct labor, and they're expected to use 1/4 of an hour for each box of crayons. So if the actual number of units that we sold is 52,000 boxes, our flexible budget would show 52,000 boxes times 1/4 hour per box times $12 per hour that we pay. And that all multiplied out is $156,000. So on our flexible budget, we would show $156,000 that we expected to pay for direct labor. If the actual cost for 52,000 boxes is $145,600 for 10,400 direct labor hours that we actually used, then we can figure out how much did we pay per hour on average by taking the $145,600, dividing it by the 10,400 number of hours we used, and that gives us $14 per direct labor hour. So that is our actual cost per unit per hour. And we used 10,400 hours. So the total flexible budget variance that further needs to be analyzed is the $156,000 that was our standard from 2 slides ago, and subtract out our actual from the previous slide of $145,600, and that gives us 10,400 of total variance that we have to analyze and break down. Since we spent less than we thought we would, this variance would increase our operating income, and we would call it favorables. 10,400 favorable variance now needs to be broken down. So we need to break it down, again, just like materials, into a cost variance and an efficiency variance. Okay, the direct labor cost variance looks specifically at the per hour wages and fringe benefits, the cost per hour that we paid for direct labor. And our formula is going to be the exact same formula that we had for direct materials cost variance. The AC minus the SC, the actual cost per unit, minus the standard cost per unit, and multiply that difference by the actual quantity. Same formula. All cost variances are that same formula. Then we have the efficiency variance. That considers how many direct labor hours we spent and compare that to how many direct labor hours we thought we would spend. And our efficiency variance formula is the same as the direct materials efficiency variance formula. The AQ, actual quantity, minus the SQ, standard quantity, and that difference times the standard cost per unit. Okay, so let's take a look at cheerful colors on their direct labor variances. So we'll first look at the direct labor cost variance. And we know that the standard cost, we were told, was $12 per direct labor hour. The actual cost per hour was $14 per hour that we had calculated. And our formula is AC minus SC, and that difference times AQ. Okay, so now we have everything we need, and we actually plug it in. Our actual cost per hour is $14 per hour. We subtract our standard cost per hour, the $12 per hour, and that difference, which is $2 an hour, times the actual quantity of hours that we used, which is 10,400. And so we get $20,800 variance. Explanation for cost. Is it favorable or unfavorable? We look at our actual cost per unit, which is 14. That is more than the standard of 12. Whenever the actual is more, the actual cost is more than the standard, then we have an unfavorable variance. Now we'll take a look at the efficiency variance. This looks at how many hours we used compared to how many hours we thought we would use. Now remember that we expect to use 1/4 of an hour of direct labor. So we have 52,000 boxes of crayons times 1/4 of an hour. So we expect to use 13,000 direct labor hours. And the actual number of hours that we used was 10,400. So we used less hours. The standard cost for direct labor is $12 per direct labor hour, and our formula is AQ minus SQ times the standard cost per unit. And this is the same formula for efficiency variances for direct materials. So now we have everything we need to plug in to our formula. Our actual quantity of hours is 10,400. We subtract out the standard quantities of hours that we thought we would use, which is 13,000. That difference is multiplied by the standard cost per unit, just $12 per hour. And so we get $31,200 variance, efficiency variance. Is that favorable or unfavorable? Well, we take a look at our actual quantity is less than the standard quantity, so that causes our variance to be favorable. Now we take a look at making sure that we've got it right. Okay, we had to explain a $10,400 favorable total variance into two parts, a cost variance and an efficiency variance. For the cost variance, we got 20,800 unfavorable. For the efficiency variance, we got 31,200 favorable. We have a favorable and an unfavorable, so we're going to subtract. So the 31,200 favorable minus the 20,800 unfavorable is 10,400 favorable. Good, that checks. We have explained the variance by showing that we have more operating income because we used less labor than we thought we would, but we paid $14 an hour rather than 12, so that kind of partially wiped out the gains we made from efficiency. If we had paid $12 an hour, then we would have a $31,200 total variance that would be favorable. Our operating income would be $31,200 more than we thought it would be. However, because we spent a little bit more per hour, we only have a $10,400 favorable variance instead of the $31,200. So this whole thing might have happened if the fact that we paid that higher per hour means that we got more experienced workers, okay? And they were able to do the work in less time. So sometimes, a lot of times a company will think, oh, well, we'll just pay the cheapest we can. And if that's unexperienced, whatever, So here, in this particular case, by getting more experienced workers, we were able to get the work done a lot quicker and actually saved money, $10,400 in total, even though we had to spend more.